Hello everybody, this is Dawn Fotopulos. Welcome to the Biz to Credit and Hidden Profit webinar. It's called Build Your Multi-Million-Dollar Business That You Can Sell. I'm Dawn Fotopulos. I want to welcome you here. In the next 45 minutes, what we're going to do is we're going to take you through a deep dive as to how to maximize the terminal value of your business and what sorts of things you need to think about before you decide to sell a business. So let's get going. Okay, this is the third of 3 webinars. The first was 50% more profits in 5 weeks, and we were not blowing smoke. We talked about the net income statement and showed you in 5 simple steps how to improve your profits by 50%. The second webinar, which we did just around Christmas time, was we showed you in 5 weeks that you actually could improve your cash flow by as much as 100%. And I've done this for thousands of businesses. We can do it for you as well. And this is the third in the trifecta, building $1 million business you can sell. And we're going to review the balance sheet because that's the statement on your financial dashboard that a prospective buyer and any investor is going to really care about. So let's get into it. First, a little bit about me. You know, who is Dawn Fotopulos? I am Associate Professor of Business at the King's College in New York City, but that is my 6th career. I was a Vice President for Citibank. I've done turnarounds for many years. I'm a serial entrepreneur. I was a hedge fund partner, a real estate investor. I am also an award-winning author of a book called Accounting for the Numberphobic, a survival guide for small business owners. The publisher is Amacom Books, the American Management Association. And it is just recently being translated into Chinese, so that's quite exciting news. But my passion is to help small businesses survive in any economy. And my blog is called hiddenprofitprofit.com, and you are welcome to join and visit me there anytime. Before we get into the nuts and bolts of the presentation, I wanted to quote Norm Brodsky, who was actually Chapter 10 of Accounting for the Numberphobic, and he said the following. It was really quite sobering. He said, a business is all about the numbers. Most businesses could make it if the owners knew even the very basics of reading their financial dashboard. And I have to tell you, not only was it sobering, but it was really an opportunity for us, because what he's really saying is a 50% failure rate is not a foregone conclusion. A 50% failure rate of small businesses in the first 4 years of operation does not have to stand. So let's see what we can do about helping you build $1 million business that you could sell. So here's the deal. There are 3 big questions every single company has to ask, whether you're public or private, large or small. Are you making a profit? In other words, are you making money? Is there enough cash to run the business? And is the business building wealth or destroying it? In other words, is the application of these assets very efficient so that you're actually creating value and you're building something that grows value over time? So your financial dashboard holds the key to answering those 3 questions. Your net income statement is going to answer whether or not you're generating a profit from your business. Most people know that. Your cash flow statement is going to show you whether or not there's enough cash to pay the bills. And your balance sheet is really the catcher's mitt of everything that has happened in the business from the time you opened your doors until today. It's a little complicated, but not any more than the first 2 that we've been through. This presentation is primarily going to focus on your balance sheet because, again, that's your 360-degree view of everything that's going on in the business. So the same way you have a dashboard in your car to help you orient what's going on with your automobile, you have 3 key gauges in your business that are going to help you orient exactly what's going on in your business. So let's look at the balance sheet for a moment. The balance sheet captures essentially the net worth of your business. It's the net worth statement, okay? And there are 3 parts to it. It's not more complicated than that. The assets are things that you own. Liabilities, those are things that you owe. It could be credit lines, mortgages, or so forth. We'll go into greater detail in a minute. And the difference between the 2 is what's called your owner's equity. You have this with your house, right? What you own, what you owe, and what the thing is worth. actually what is the equity in your house. So the value of your home minus the outstanding mortgage is basically the equity or the net worth that you have in your house. So what's interesting is this equation is exactly the same for your personal life as it is for the business. So that's kind of the good news. You're already familiar with this, but let's understand how important this is in terms of driving terminal value. Okay. So your assets, your liabilities, and your owner's equity. Now you know what the relationship is, and you can see that equation on the bottom. Assets, what you own, right, what you have title to, minus your liabilities, what you owe, is basically your net worth or your owner's equity. So your asset base, in building a business you can sell, your asset base is the key. The bigger it is, the faster it's growing, the better it is for you. Your liabilities need to be in a healthy balance with your asset base. If your liabilities, in other words what you owe, are growing too fast, that's a problem. But again, we'll get into that in a second. Remember something, please, very important. Your owner's equity is why you're in business. That's really why you're in business. All the other stuff that you do day to day, it's really to build owner's equity. So let's start with the end in mind. If you want $1 million valuation, if you want a business that's worth that, what do you have to do to get there? So let's just understand some of the underlying assumptions. Okay, who actually buys a business? Well, your competitors might buy you out. And don't laugh, because it happens all the time. In fact, they are probably the first place I would look if I was trying to sell a business. Or we might look to internal staff members. There may be people inside the company that are super loyal. They know everything that's going on. They would be the ideal folks to take the business forward into the future. And that could be a fairly seamless transaction if you had the right kind of people with the right motivations. Sometimes relatives, that could be a mixed bag, right? So it's not just the fact that they're a blood relative, but it might be somebody who has taken an interest in the business, who's worked in the business and worked their way up. Or you might have suppliers that are interested in the business. And that's very common. But the bottom line is any buyer, no matter where they come from, they are buying the future of the business. And the second thing you have to remember, that when you do have a buyer, whatever the deal is, the buyouts are rarely for cash. So it's not like you can just sort of take your cash and run. Most of the time, buyouts are, or purchases, company purchases, are purchased over a period of years. And the business itself kicks off enough cash to support the buyers. So the big takeaway from today is please don't wait until the heart attack comes or the cancer diagnosis comes. Please be prepared and think about selling your business years before you actually want to do it. So now here's a data point that's very interesting. Nobody knows about this, but it's important to know. The front end of the baby boomers, the people that are in their early 70s, mid-70s, control about $4 trillion in annual revenues in the aggregate of all the small businesses that they own. Most of them do not have succession plans. Most of them have absolutely no idea if, when, and how they're going to sell their businesses. And please don't be one of those. Okay? And we're going to give you some points and tips as to how to think about preparing your business for sale. Okay, so you start with the end in mind, and remember something. You're not sacrificing your life to pay bills and die. You're not sacrificing your life to just buy yourself a job, because you could go work for somebody else without any of the hassles and the sacrifices. You can do that. Remember something, that's bullet point number 2. You need at least a 5-year off-ramp to maximize the value of your business. And that's not my opinion. That actually comes from Harvard Business School and the research that's done with some of the major consulting firms. A 5-year off-ramp is about what you need in order to position the business for sale, make sure you find the right buyers, and maximize that terminal value. So there's always going to be a tension, if you're going to sell the business, between lowering your yearly taxes and also maximizing your terminal value, and we'll get into that in a second. So here's the realistic assumptions between the buyer and the seller, right? They come from very different perspectives. The buyer turns around and says, your baby's ugly. I don't think your baby's so terrific. What are they trying to do? They're trying to chisel you down. They're trying to pay the cheapest price they can for your business. Meanwhile, the seller always thinks, my baby's beautiful. My baby's worth millions and millions of dollars, and why can't you see that? And there's usually a gap. And the place that you see that especially is on some of the TV shows like Shark Tank, and we'll get into that in a second too. But at any rate, if you're going to sell your business, that 5-year off-ramp, there are a number of conditions that need to be met in order for the transaction to occur. And these 3 are non-negotiable. And nobody ever talks about them, which is surprising to me, but you'll hear about it here. The first thing is your business has to be a going concern. You have to have a client base. You have to have predictable revenue streams. You have to have predictable cash flow. And that term going concern is a very formal term in accounting, and your firm has to meet that criteria. And if you're not sure if you're a going concern or not, you can ask your accountant. But the bottom line is, first stop, going concern. Second stop, all of your numbers need to be documented and they need to be audited. So in other words, you have to have evidence of what the valuation of the business is, because that doesn't come out of thin air. It comes based on the cash flow and the profitability from operations and trending and future potential and all of that. The third criteria is that your business itself is an asset. Typically, if you're a corporation or an LLC, it is its own separate entity, almost like another person, and it's got to be transferable. And the only way that can happen is if there is clear title to the corporation. In other words, we need to know who owns it, or what percentage of it do they own, because if you don't know that, you can't convey it. Remember, if you were to buy, for example, a home, the bank, if you're going to take a mortgage, is always going to ask for a title company to check to see that the title is clear. Why? Because you can't convey the house and the property unless title is clear. It is the same thing for a business. Okay, so it's got to be transferable. So I love Shark Tank. 4 million people are cheering with me every Friday night. And what you'll notice, whenever the business owner shows up and is asking for money, they imply what they think the value of the business is. And the investors never, very, very rarely, let's say, agree with the business owner. The investors usually think it's worth a lot less. So the first thing they ask about is, you know, what is it that you're selling? You know, how different is it? How better is it than the competition? Is the competition strong or weak? Why do they care about that stuff? Because they're proxies for demand. They're also indications if it's easy or difficult to compete with you. If it's more difficult to compete with you, that creates barriers to entry. That protects your revenue streams. They like that. Investors like that. Buyers like that. Strength of competition is important, because if competition is very strong and they have deep pockets, then it's going to be very easy for them to try to steal your customers. If competition is fragmented, if competition is not terribly powerful or well differentiated, that actually gives you a good, clear vision for how to build a client base and build your revenue streams profitably. So your client base, is it growing? Is it profitable? Are they loyal? Are there names in that client base that are household names that would indicate how, wow, you know, there's Bed Bath & Beyond that cares about what you're doing, or Lands and Yacht Stores, or whoever it is. And you'll see on the tank that if a business owner is already doing business with a large retailer, that provides a lot of credibility, and in fact lowers the risk for any investor or buyer. What are your revenues? What are your gross margins? What's your cash flow? How are they trending? How are they growing? All of these things get put into the equation to help determine what your business is worth, not just today, but what it's going to be worth in the future. Because don't forget, a buyer's buying your future. So, okay, how does an investor look at your business? Now, again, we're looking for $1 million business we can sell. They're looking at multiples of 2 primary things. They're looking at multiples of your profitability, and they're looking at multiples of your cash flow. Multiples meaning usually 3 to 5 years. So whatever your annual cash flow is today or last year, they will multiply that out by 5 years and suggest that at a minimum that's what your business is worth. They may look at profitability and come somewhere in between, but understand that every industry has some industry standards about what that multiple should be, and you should know what that industry standard is. Then they're going to look at your client base specifically. Why? Because your client base is the revenue producing engine of your business. It's also the gross margin producing engine. It's the profitability producing engine. So how big is your client base? How loyal are they? And then how profitable are they? So cash flow really is king, and most buyers are looking for 2 primary things. They're looking to buy cash flow, and they're looking to buy our client base. So Instagram was sold for $1 billion a few years back, and there are two things that we learned from the parent company. The first thing is that buyers are lazy. They really are. They don't want to build a client base. They don't want to spend all that money all the time. They'd rather buy your client base. It's a lot easier. It's more expensive to do that, but it's a lot quicker. So client bases, what they're really doing is they're buying future revenue streams. When you buy a client base with some predictable revenue streams, you're really buying those revenue streams. And when you take a look at any of the mergers among large companies, that's essentially what they're doing. They're reducing operating expenses, and they're buying a client base. They're buying revenue streams. In this situation with Instagram, they had 1 million rabid users of the software. And because these people were on that platform all day long, the parent company paid $1,000 per user. That's where the $1 billion comes from. $1,000 per client in that client base. Isn't that unbelievable? So the buyers really are looking for cash flow, and they're looking to buy a customer base, and they're also looking to buy growth. So remember this, okay? The greater the predictability in your cash flow and your profitability and the behavior of your client base, the higher the terminal price is going to be for your business. All right, so let's do a little comparison here. Two flower shops. One is Fresh's Flower Shop. The other is David's Flowers. They are essentially the same size. Small little example. True story, though. They're both doing about $100,000 a year in revenues, about $7,500 a month in sales. They generate $20,000 in free cash flow per year, so their expenses are about the same. Their ratios are about the same. But isn't it interesting that the Freshest Flower Shop was sold for 3 times their annual free cash flow for about $60,000. On the other hand, David's Flowers was sold for $100K or 5 times annual free cash flow at a 67% premium to the Freshest Flower Shop. And you got to ask yourself a question, they're so close in size and dynamics. Why is it that one got 67, almost 70% more than the other? Now, this is a small example, so you can say, well, what's the difference for 40,000? Well, if that was 4 million, that would really open up your eyes, wouldn't it? I will tell you, Freshest Flower Shop was run like a little mom and pop. They had invoices stuck in between their couch cushions. They didn't have financials that were readable. They didn't have really good bookkeeping. They accounted on a cash basis, not an accrual basis. They couldn't prove what was happening in the business. So when the purchaser decided they wanted a presence in that geography, they did not pay the maximum price for that business, simply because the business didn't have its act together. The other thing that happened with Freshest Flower Shop was that the flower shop owner, who had been there for 30 years, right, had a heart attack, and the business had to be sold under duress. Whereas David's Flowers, they had actually a 3-year off-ramp. They were able to position the business. It was what we would call a very orderly transition, and there were people who were able to stay on and make that transition seamless for the new buyers. So those are the kinds of things that really matter about terminal value. So don't look at these numbers, look at the comparison and understand how important it is to do that forward planning, okay? And in a minute we're going to give you some of the drivers of terminal value, so let's go through it. We talked a little bit about cash flow and revenue, so I joke a little bit, right? Cash flow is emperor. It is the single most important driver. It's not the only driver, but it's very important. So we're looking at things like return on invested capital. We're looking at things like burn rate coverage. In other words, how well is the business generating cash flow, and how easily can it meet its obligations, and how easily is it building its asset base. Revenues are king. Revenues are great. They're important. They need to be trending higher. But the challenge is those revenues have to convert into cash flow. So if you're doing business, if you're a service business, for example, and you invoice your clients, you got to collect on those invoices. Because if you're not doing that, the revenues are not going to be enough to build that terminal value that you're after. So in a second, we'll go through the cash flow management cycle. So growing your client base is queen, right? Because growing your client base is a proxy for things like market share growth, future potential. Why? Future potential because your client base drives your revenues. It helps drive gross margin. So the other thing we want to look at is we want to look at things like competitive advantage. We saw that when we were talking about Shark Tank, right? That's the prince. What are the barriers? What are the things that make it difficult for your competitors to steal your space, steal your customers? So before you do anything, you must make sure that you have documented, audited, accurate, and timely financial statements. You have heard me beat the drum about this in every other webinar I have ever given. And I can't tell you, if you do nothing else but you fix your financial statements and make sure that they are current, accurate, and complete, you are already ahead of 9 out of 10 of your peers. So understand that the companies that have the highest valuations reflect all the things I just discussed on this slide. Good cash flow, good revenues, growing client base, and competitive advantage. And clean, dynamite, current financial statements. Okay? All right. The primary question we are really answering in this presentation is, are you building wealth? Are you destroying wealth? And how in the world can you tell? So the balance sheet is going to give you all of those answers. And the point is, if you are building wealth, you will build that $1 million business that you can sell. If you are destroying wealth, what's actually happening, and I'll go into it in greater detail, is money's coming into the business, and instead of the business creating positive leverage, where that money, whether it comes from loans or investors or what have you, is getting lost through the floorboards because your gross margins aren't high enough, and you have to keep bringing money into the business in order to keep the business afloat. So let's talk about this. In Chapter 9 of my book, it's called How to Win Friends and Influence Bankers. And the balance sheet is the net worth statement of your business. And a banker or an investor is going to hone in on that balance sheet. That will be the first thing they will look for. And they will consider this sexier than a string bikini, trust me. So the same way you have a personal net worth, your business has a net worth. It is the relationship between what you own and what you owe. And that equation that we talked about earlier is exactly the same for the business. So your liabilities minus your assets is your net worth. So let's understand something. The value of your business is not just the salvage value of the desks and the computers. It just isn't. It's much more than that. Does your business have terminal value? Yes, and it can be sold for far more than just annual revenue. So let's take a look at an actual, at a sort of sample balance sheet. Okay, these three sections that we talked about, the asset and liabilities and the owner's equity, this is how to read this, okay? The asset base, building your asset base is the primary objective of running a business. I'm going to say that one more time. Building an asset base faster than building your liabilities is why you're in business. Because if you do that, if you build these assets faster than liabilities, guess what happens? Owner's equity starts to swell. And if owner's equity starts to swell, guess what happens to the valuation of your business? It goes up, okay? So let's take a look at a sample balance sheet. It's pretty straightforward. Current assets are those things that are cash or convertible into cash within 12 months. So here we've got cash at $5,000, receivables of $2,000. So our total current asset base is about $7,000. And that's important. You know why? Because if we had to pay our liabilities right away, if something happened right away, we've got $7,000 of coverage that we can use right away to cover those liabilities. Fixed assets are things that are convertible into cash beyond 12 months. It might take a year or two to sell a building, sell a piece of land, and that's why it's considered a fixed asset. And here we show 15,000. So if we add 5,000, 7,000, 15,000, we come up with total assets of 22K. That's all that is. Whether you are running Procter & Gamble or whether you are running the corner pizza store, your asset base is calculated exactly the same way. You may have a few more budget lines on here if you're Procter & Gamble, but it is essentially the same structure. So does anybody have any questions about what I went through? Okay, good. Let's take a look at liabilities. Accounts payable and credit lines payable, these are current liabilities. That means no matter what happens in your business, you got to pay that back within the next 12 months. And that's sort of like a noose around your neck. What we want to do in a perfect world is we do not want these numbers to swell faster than these numbers. We want these numbers, in fact, to help finance receivables, to help finance inventory, which I don't actually have on here, but that would also be considered a current asset. So in this case, we've got accounts payable and credit lines payable, and that could come from a lot of different places. It could be a credit card that you have on the business that is a revolving charge. It could be an account payable with a supplier that you have to pay back within 30 days. So at any rate, those are current liabilities. Long-term liabilities imply exactly what long-term assets are, or fixed assets. These are things that have to get paid back, but probably it's going to take longer than a year because those are the payback terms. A mortgage is a good example of that, and here the mortgage is $10,000. If you add all the liabilities together, we're looking at total liabilities of about $13K. So if we take our total assets, $22K, minus our total liabilities of $13K, guess what? We're left with owner's equity of $9K. And that's all that is. Now here's the deal. If we can grow these assets, whatever they are, either total current or fixed assets, faster than we can grow total liabilities, this $9,000 is going to begin to swell, and that's going to help your terminal value. So what's the strategy then for maximizing owner's equity? Well, you're going to improve it by doing essentially two things, by increasing asset values, which is over here, and you can do that three ways and probably more than that. We don't have time to go over more than three ways. But if you increase gross margin on every sale, it will increase your asset base. You know why? Because if you collect against your sales, it's going to improve your cash position. Every time you sell an item, it's going to throw off more cash towards your asset base. All things being equal, your owner's equity will go up. Okay, so your gross margin, this is why I keep banging the drum about gross margin. The higher your gross margin, the higher your asset base is going to be. The other thing that happens with gross margin that's really important is that if you're selling inventory, and particularly if you're in a product business, for every product you sell, you want that product sale to work super hard for you. So you want to make sure you're selling the highest gross margin products that you can. You want to build your cash base, and you want to sell more, and as you sell more, your accounts receivables are going to go up. And as your accounts receivables go up, it's going to become very important to convert those receivables into cash. So increasing your asset values, right? Increasing your asset base right here becomes really important. I just gave you 3 ways or 4 ways to do that. There are 100 ways to do it, oh, by the way. Decreasing liabilities is the other way. Paying off your debt. As soon as you bring cash in, pay off your debt. Make sure your ratios are sound. If you use some debt capital to invest in really effective marketing techniques, I'm not talking about throwing money against the wall and praying that you get a return. I'm talking about very targeted, very well-proven marketing strategy. It may be worth it for you to do that. But remember something, for every dollar you spend in marketing, you got to get 5 back in revenue. If you're not getting that, you're not getting an adequate return on investment. The other thing, too, is you can use debt to invest in assets. You might want to take out a credit line, for example, and upgrade your software, upgrade your hardware assets in the business. You might hire an IT consultant. You might want to hire somebody to train your staff so that you become more productive and more efficient. These are ways of using leverage in a really positive way, because by doing this, even though it's implied in the business, you begin to build your asset base because you do more with the same level of expenses. So the most important thing to remember about liabilities is you want to match the life of the asset to the length of the loan. If the asset has a 10-year life, then take out a loan, pay it back in 10 years. If the asset, like inventory, has a 6-year lifespan, a 6-month rather lifespan, then make sure that you're managing that inventory and financing that inventory with current debt. Okay. So if we want to take your business and in 5 weeks' time build it into a $1 million business that you can sell, how in the world would you do that? So let me give you a vision for how that's possible. I know you're going to think I'm nuts, but just follow the analysis because we've done this in the real world. First of all, the way you build a $1 million business is not necessarily by finding new customers. And that actually is counterintuitive for a lot of people. A lot of people think, well, the only way I'm going to build a multi-million-dollar business is if I find new customers. Not if they're not profitable, okay? The first thing you're going to do is you're going to fix your profits and make absolutely sure that every client that is in your client base is profitable. And if Harvard Business School is correct, a third of your clients are profitable, a third of your clients are at break even, and a third of your clients are unprofitable. Not just maybe, highly likely. And what I have found is that most business owners have no idea what clients fall into what buckets. They think the largest clients are the most profitable, and that's not necessarily the case. So, okay, what would a 5-week program look like? Well, the first thing is you're going to fix the books in week 1. In week 2, we would take a look at increasing the gross margin on your products and services. And in a minute, I'll take you through a little bit about what that looks like. In week 3, you're going to clean up your client list. Because if what I just said is true, we need to find out which clients aren't generating gross margin and profitability for you, because what we don't want to do is scale an unprofitable business. Week 4, we're going to clean up the cash cycle. In week 5, we're going to align your assets with your liabilities, and we're going to optimize owner's equity. So weeks 1 through 4 about doing all the building blocks to what happens in week 5, and that's building owner's equity, which then becomes the jump-off point for your terminal value. So, okay, what would a 3-month plan look like? First thing you're going to do in week 1 is you're going to fix the books, and you're going to identify your successor. Okay, this is essentially the big red arrow at the mall. This is your starting point. So the first thing you have to do is you have to make sure that everything that is going on in the business is documented, it is audited, it is accurate, it's timely, and it's complete. And some of the errors that I've seen over the 20 years or so I've been doing stuff like this is I've seen a lot of double counting in things like revenues. I've seen a lot of expenses that are not captured properly. I've seen a lot of cash basis accounting because, quite frankly, it's a lot easier just to book cash as it comes in and out of the business, but there's the problem with that because cash basis accounting is blind to the people that still owe you money that haven't paid you yet, and the people that you owe money to, your payables that are not captured. So your receivables and your payables are a very, very important part of getting a 360-degree view of your business. So whatever accounting you are using, if it must be on an accrual basis, again, if you want to sell this business at some point in the future. So if you're on a cash basis now, I really want to encourage you, especially because we're in the beginning of the year, is to transfer and speak to your accountant about going to accounting on an accrual basis. And last but not least, you're going to shift your priorities from minimizing taxes, which a lot of people do, it's perfectly legal, to maximizing cash flow and maximizing profitability. Because those are the two things, quite frankly, that are going to drive your terminal value. So it's the new year. It's a great time to begin to reset those priorities. Because here's the challenge for us. If you're only playing the minimized tax game from now until the time you sell the business, it's a real problem because you're going to think the business is worth more than the potential buyer actually believes that it is. So let's keep going. You're going to increase the gross margin on your products and services, improve your operations, streamline your offering, get rid of those services and those products just draining cash out of you, draining time, using up valuable resources, not providing a good return. You want to capture all your variable costs so that the your gross margin is accurately reflected on your books. What does that look like? There are a lot of service businesses that do not do a good job of this, and most of us on this call are running service businesses, if we're honest, right? Whether we're consultants or we are web designers or we're interior designers. So super duper important that your direct expenses are captured in your cost of doing business line so that you know if you're really generating gross margin for what you're doing. eliminate the cash drains, eliminate your problem clients, and review your pricing strategy. These are ways to increase your gross margin. It's one thing to say it, right? It's another thing to actually do it. Cleaning up your client list is no small task. You got to focus on your loyal high-margin clients. You know that instinctively, but actually doing it and how to do it is the challenge. So the first thing is, my advice to you, don't do business with anybody who gives you an ulcer, okay? The second thing is you got to check out your gross margin by client, not just revenues by client, but gross margin by client. And what's the difference? The difference has to do with the products or service set that each client buys from you. And you're going to find that even some large clients may not be terribly profitable. And in fact, I had a conversation with a colleague yesterday, and she talked to me about an office supply company that had been in business 10 years. And what they used to do is they would bundle price their toner with all these other office products, and what clients were doing, large clients, is they were buying the bundle and then they were canceling the order on everything except the toner. Because what the supplier was doing is they were using the toner as a loss leader. They were selling the toner at cost, and they were hoping to get the gross margin on everything else, but the clients were canceling everything else. So what ended up happening is they ended up going bankrupt because even on big clients, they weren't making any money. So we're going to rebalance your sales and your marketing efforts. And if you lift up your right shoe, you will see there is $1 million in gross margin underneath that shoe. Okay. Week 4, you got to clean up your cash cycle. Can we talk about this, please? Very important. Your valuation is going to be based on multiples of revenues and cash flow. Your ability as a company to convert revenues into cash flow is absolutely mission critical. So we're going to look at things like payment terms, your invoicing process, whether you look at your aging reports, and you're really on top of it for clients that have owed you money for extended periods of time. What does your collections process look like? Does everybody panic inside the organization, or do you actually know how to go about collecting from outstanding invoices? And there is a way to do that where it's not stressful. So anything that improves your cash position improves your asset base, and ultimately it improves your owner's equity. Okay, so this is just basically a diagrammatic of what we just described in bullet point format. So what are your payment terms? Are you clear about that? Are you consistent with how you apply them? Your invoicing procedures, if you don't think it's important to invoice a client, the client will not think it's important to pay you. So make sure that your invoicing is happening on a timely basis. Your aging reports. You know what that is? That's a laundry list of everybody that owes you money. You are not a bank. You are in business to generate cash flow and profitability. And do you look at those aging reports on a regular basis, and are there people that owe you money for longer than 30 days? Because if there are, you got to jump all over that. And that's what days outstanding is all about. Days outstanding are essentially how many days from the day that you've invoiced the client to the day they've actually paid you, or how many days are still outstanding where you need to be paid and you haven't been paid yet. And then, of course, your collections efforts. This is an internal discipline. It's not hard and it's not intimidating if you know how to do it. So that's your cash cycle. And by the way, a buyer is going to care about that stuff. And then week 5, which is sort of the culmination of everything that you've done before, you got to align your assets and your liabilities. You've got to look at things like current ratios. Don't be intimidated by the term. Current ratio simply takes your asset base and it divides it by your liabilities. And if your assets are bigger than your liabilities, then that ratio is going to be higher than 1. Does that make sense? That's all that means. But we want that ratio always to be higher than 1. And frankly, the higher that ratio, the stronger the business. And you've heard things like, so-and-so has a strong balance sheet. What they're really saying is the asset base relative to the liability base is much larger. So if they had to pay off all their liabilities, it would be easy for them to do. Another way of looking at the relationship between current assets and current liabilities is to look at something called working capital. And working capital is nothing more than just taking the really liquid part of your assets and the really liquid part of your liabilities, that is the current portion of assets and liabilities, and check to see if your current assets are less than or greater than your current liabilities. So here's a hint. If your current assets are less than your current liabilities, you are functionally bankrupt. You may not feel it yet, but you are. And that's not my supposition. That came from Norm Brodsky. So we always want current assets to be larger than current liabilities. Okay, so one thing you need to know, what's your industry standards? Because every industry has them. And you want to beat those industry standards because that's going to help your terminal value. And what you really want is you want such a great hot company that has such terrific ratios that you've got a bidding war going on, that you've got a bunch of people, a bunch of companies that want to buy your business. Because if you have that, then guess what happens to your terminal value? It goes up. So I was joking a little bit, and I said make sure you're not selling used cars because it's a very, very tough business. You're selling depreciating assets at the end of their useful life in many cases. You're selling them on credit, and if you're selling into a weak market and people default on their credit, then you're not getting paid back, you're not getting return on capital, and you're sitting with a depreciating asset. So that's one quick way to degrade your balance sheet and your owner's equity. So, okay. Week 5 is really important about aligning your assets and liabilities because that's part of what really should be a 3-month plan for you if you want to build a $1 million business you can sell. So this is really forecasting what the next 90 days is going to look like. And we would focus, if you and I were working together, we would focus on the marketing cycle. In other words, how we bring new customers and how do we work and build deeper relationships with existing customers. How do we close a sale, price a sale, negotiate for payment terms, and so on in the sales cycle. How do we invoice a client, set payment terms, invoice a client, collect on outstanding invoice, and so on in the cash flow cycle, and expense management and debt management. I'm not going to go into that in great detail here, but these are the things that you really should be thinking about, and don't freak out because in a minute I'm going to show you a very simple way that you actually can do this in your life. It looks very complicated, but I promise you I'm going to show you a roadmap and make you an offer that's going to be really easy to follow. So a lot of people have said to me, there's so much here. Can we review that again? I have a colleague who needs to hear you. There are tons of people that signed up for this webinar that for whatever reason couldn't make it. We all have busy lives. Do you have notes? I know 50 people who need this and so on. I just gave a talk at the American Management Association yesterday, and they were all over me saying, oh, is it recorded? I want to see it. So here's the deal. It doesn't matter if you're not an accountant. The way to build terminal value is not to become a CPA. You don't need special qualifications, and even frankly, if you hate accounting, it doesn't matter. I'm going to show you a proven system. I gave you some glimpses in that 5-week roadmap where you will find hidden profits and you will find hidden owner's equity that you didn't even know was there. So I have developed something called the Hidden Profit Academy for people just like you. It's a 5-week challenge. And we figure out in those 5 short weeks how to get you to a larger terminal value than where you are right now. And it is a roadmap. It's a step-by-step system. And we will accomplish in 5 weeks what years of struggling on your own will not accomplish. And I know this because I've worked with hundreds and hundreds of small business owners. So you tell me how it would feel to build a $1 million business that you could sell. What about if all those sleepless nights you finally got that return on investment, you finally got that big payday, that frankly you deserve, that frankly you have sacrificed an awful lot for. You are not here just to create a job. You could go do that somewhere else without any of the risk. So trust me, it is possible if you know the roadmap. So let's talk about what that roadmap might look like. The Hidden Profit Academy basically breaks out this 5-week challenge into 3 core courses and 2 bonus courses. So the first week is you learn about how to improve your profitability by 50%. That actually is very reflective of the very first webinar that I did through the Biz to Credit with my Biz to Credit strategic partner. And if you were there back in November, you heard a lot about how to build 50% more profits. Week 2, we would focus on 100% more cash flow. And that cash flow cycle, there are 10 training videos in this. Each one is between 6 and 8 minutes long. and in the time it takes you to drink a cup of coffee, you can look at that and it will change your life, no joke. Week 3, I will take you through how to improve your balance sheet so we can improve your owner's equity. The bonus courses are come in week 4 and week 5. Guerrilla marketing, I'll go through in greater detail, but that's really how to find more profitable customers and how to build more gross margin among your existing customers without having to spend real money on marketing. And sales secrets is how to pull the trigger, close business faster, and how to improve your average sale. As I have put people through this Hidden Profit Academy, I will tell you that I'm on the live call every week. I make sure we're pushing the ball down the field every single week, and I know everybody is busy, but everybody can take this 5-week challenge. Because if you don't take it, 5 years from now, you're still going to be in the conundrum that you're in right now. Okay, so 50% more profits, that's the first course. There are 15 videos in that course. They are in order. Each one, again, is between 6 and 8 minutes long. It's not a huge time commitment, but it's power-packed. It's me guiding you directly. And if you are pitching investors, if you're interested in pitching banks, or if you're interested in finding buyers to buy your business, you really need to know this stuff. And you're not going to get it anywhere else. And it's really quite fast, and I have a crazy sense of humor. So we can take a lighthearted romp through some serious business. The second course, 100% More Cash Flow, will take you through your cash flow statement, and it will teach you how to manage your payment terms up front. And this is no small thing because most business owners do not do a good job of this. I'm going to show you how to invoice a client and how to create an invoice that is so compelling the client can't wait to pay you. I have tried it in my own life. I have hundreds of proteges who have done this, and they've all raised their hands to give me testimonials. I'll give you insider tips on the frequency and average invoice size so that your invoice gets first priority and you get paid first, which is dramatically helpful for your cash flow, and a very painless way to collect from customers who owe you money. And it seems impossible that there is a painless way, but trust me, there is. Last but not least in this trilogy, to build $1 million business you can sell, I'll take you through the balance sheet, how to manage your long and short-term debt, when to take on debt, and when to run for the hills. Most people do not know this stuff, and it sinks their business when in fact they could have $1 million business to sell. I want to talk you through mistakes that you should avoid to improve your loan acceptance rate and also to help you avoid predatory loan practices, because that's super important. There are a lot of businesses out there that are paying way too much money for cost of capital, and you don't have to be one of those. And at the end of the day, I want to show you simple ways to build your asset base to build your owner's equity, which is the key to your $1 million valuation. What Sales Secrets will do, it'll show you the top 10 ways world-class companies ring the cash register probably faster than you do. I'm going to show you ways where you never have to cold call again. Never, ever, ever have to cold call again, and you can double or triple your closure rates. And I have built, by the way, $100 million businesses with this strategy. And then how to get customers to become your free sales force. That's the way you really get positive leverage. So your guerrilla marketing course is how to build revenues without investing big money in advertising or promotion. And this is based on 15 years of research at Harvard Business School. So we are not blowing smoke here. And then the Sales Secrets course is going to show you how cold calling is gone and you don't have to do it. We're going to show you how to triple your closure rates and triple your average sale. Okay, bonus number 3, you're going to have a study guide for each and every course. So you will have a study guide for 50% more profits, 100% more cash flow, and the $1 million business to sell, as well as the bonus courses, Guerrilla Marketing and Sales Secrets. So you don't even have to take notes. It is all there step by step for you. There is a 4th bonus, and I really want you to have my book. Not because I wrote it, but because it will mirror everything that you're going to be looking at in the course. It's a great textbook, but it's really a fun read. It is the only book on accounting that will make you laugh. It's illustrated by Ron Bucalo, who's a Disney artist, and it's really designed to break through any intimidation or any concerns that you have about statement management and basic accounting. And if you go on Amazon, we have 62 really bona fide comments about the book, and it will be a very big encouragement to you. But I will give this to you as my gift. So if we were to put a dollar value on all of this stuff, like what's it really worth, right? So each of these courses is worth roughly $500. The study guides, the book, and the book study guide, because there is a study guide also for the book, is worth in the neighborhood of about $2,800. And no, I'm not blowing smoke because I actually have sold this stuff for this. So, but everybody's been so gracious, and it's really important to you and to me that that you succeed. So you've invested 45 minutes of your life. I want to make sure that this is not just a do-it-yourself, but you watch these videos, and then I want you to apply this to your world. I will have 2 personal consultations with you. After you have gone through each one of these courses, you're going to send me your financial statements. I will review them, and then we're going to strategize about how to improve your balance sheet and your ratios. And you will leave with a 90-day action plan in your hands. And this link below here is going to show you how to access the course. So you'll get 2 strategy sessions with me. You get the 3 courses, the 2 bonus courses, the guides, the weekly calls, as well as the book. When you add all of that stuff up, it isn't $2,800. It's about $5,000 worth. Because right now, actually, I bill out at about $700 an hour. And I'll be giving a keynote in the Bahamas in May, and I'm charging $10,000 for an hour for that keynote. So just to give you an idea, you and I will have one-on-ones. So just to give you an idea of what is possible, I worked with an auto dealer. He had a $6 million business. He couldn't pay the bills, and he had essentially 4 businesses. He sold used cars, he financed them, serviced them, and then he had a roadside towing business. After week 2, he read through and went through 50% more profits, 100% more cash flow, and then he and I got together over the phone. He sent me his financials, and I have to tell you, it was very sobering, but the good news was after 1 hour we focused on his invoicing and collections, and we, no joke, found $100,000 more cash per month than he ever thought was possible. I also told him to close 2 of his businesses, by the way. So now he has a $3 million business he can sell because he's generating $1 million a year in free cash flow. $1 million a year. How would your life change if you did the same thing? So his business is not $6 million. When it was $6 million, it was worthless because he was showing losses and he was in a cash crunch. But now that we reshaped his business, he can sell this business for $3 million. Okay. Biz to Credit and I and the Hidden Profit, we have a very important strategic partnership. I am committed to the clients that work with Biz to Credit. Today, the value of these courses I want to make available to you for just under $2,000. The total value, as you know, is $5,000 with the personal consult, and you get 100% money-back guarantee, but it's really important that you take action today. But what if we could do something even more special for the people who are here? Okay, what if you had free access to everything for 7 days? What if you signed up today and you could watch everything you wanted, get access to the guides, keep the book as my gift for nothing? I want to make that available to you because it's really important to me that you have access to this. It will change your life. There is no long-term commitment. After 7 days, I will send you a personal invitation and invite you to the full program, but you have access to everything, all of the training videos, all of the study guides, and the book in those 7 days for no obligation. So after 7 days, there will be an exclusive offer just for those who sign in today. This is the link. I will send you a link after the webinar is over so that you have it and you can view it on your own. So what if you could double cash flow in 5 short weeks? What if you are on the path to $1 million business in less than 2 months? How would it change your life? Please don't miss this once-in-a-lifetime opportunity because there is no place else to get this. I am the only person who's talking about this stuff. So there is no cost to you. You have everything to gain and nothing to lose, and if you don't do it now, then when are you going to think about this stuff? Please don't wait until something hiccups in your life where you're in a crisis. We've got 7 days to change your life. I am on the mission with you. I am Dawn Fotopulos. The Hidden Profit, Profit.com is where you can find me. Dawn Fotopulos on LinkedIn. I would love to hear from you, and I would love to link to you on LinkedIn. That is my personal email, dfotopulos@gmail.com. Please reach out to me. I answer every single one of my emails, and I am thrilled to be with you. And if you have any questions, we'd love to take them now. Does anybody have any questions? Oh, wow, that's a terrific question. Okay, so John asks the following. Why does it take 5 years to prepare for selling a business? Wouldn't 1 year be enough? Well, 5 years may not be required if you have a really tight ship, John, and most business owners don't. If you have really clean books, you might be able to accomplish what you need to in 3 years, but I promise you 1 year is not going to be enough, because what's going to happen is a buyer is not going to ask for just 1 year of financials. They're going to ask for at least 3 years, probably 5 years of financials, because they want to see trending, right? So you have to have 5 years of clean financials in order to do that transaction. The other thing too is, in 5 years, you need to shift the priorities, remember, like we talked about, from reducing your taxes to improving your profitability, and that actually takes some time. The other thing too is you need to clean up your client base, you need to clean up your product and service offering, you need to scrutinize your pricing schedule, and every business has an opportunity to do that and to maximize their profitability and their cash flow. So it takes time to do that. You know, we're basically, you know, reshaping the business, and I would say at least 3 years, but certainly longer than 1 year. But that's a terrific question, and I thank you for asking it. Does anybody else have another question? Succession planning. Oh, somebody's asking about succession planning. I actually didn't go into it in great detail, but I want you to please listen to me, and it's very important. Business owners are really terrible at building in a succession plan for something that they have sacrificed for decades. And there are a lot of reasons for this. Sometimes it's their baby and they don't want to share the glory, or they don't think anybody can run the business as well as they can. And in some cases that may be true, but if it is really practically true, then you haven't really done the job as a business owner. Because the most important thing you need to do when you're in a leadership position is you need to build up the next generation to basically manage your way out of a job, because the only way you're ever going to get that full payout is, in fact, if you do build a succession plan. Because your buyer doesn't want an owner that's dragging on the drapes. They want to know that you are willing to let go of control at some point, and that there is, in fact, a transition plan in place to do that. Because they also recognize, as we get older, that there are health risks and so on. But it's really important too, because the new generation is going to bring new ideas, new opportunities, and you need to nurture that before you basically pull out of the business. It's really important too, because businesses are rarely sold for cash. You need to leave the business in very strong management hands, because the business is going to pay out the new owner, the old owner, and it also has to pay for operating expenses for the new owner. So the business can't fall apart as soon as the old owner walks away, whatever that looks like, right? So that transition plan has to be in place, and a very big part of that is succession planning. And as I said earlier, you know, it could be relatives, but most of the time it's people that are working in the business who have an opportunity to buy the business out. So that was a great question, and thank you for asking it. Any other questions? Okay, last question that we'll take. What happens if you have to sell the business on an emergency basis? Well, I can tell you this. If you have to do that and you don't have a second in command who can run the business, you're going to sell this business for far less than what it's worth. I just guarantee you that. So I would say to you that you shouldn't wait for the emergency. I mean, that's the big takeaway. And in the next 5 weeks, I would love to work with everybody who's on the call to get your balance sheets in some kind of order. Let's go through that 5-week roadmap for you. Let's see what that looks like for your company. Let me take a look at your financials. Let's put a 90-day plan together for you to improve the owner's equity in your business, because I guarantee you every single person on this call has that opportunity. And for the next 7 days, it is available to you with no risk. So does anybody have any other options, any other questions before we log off? Are there any aha moments? Yeah? I hear an aha moment here. I never thought about, oh, here we go. Here's Jan. Jan says, I never thought about matching the life of the loan to the life of the asset. Yeah, that's just good stewardship, Jan, and every banker will tell you that if you ask them, but they won't offer it. Interesting. Anybody else? Any other aha moments? Yeah, Fred says, I'm so in the weeds every single day. I haven't even thought about a succession plan. I'm afraid to let go of control. You know what, Fred? You don't let go of control in one fell swoop. What you have to do is you begin to delegate responsibility bit by bit, and you test people to see if they can handle it. And the other thing you always have to do is you have to have at least 2 ways out of the room. So if a key person leaves, you've got at least somebody else with some bench strength who can take over if that person takes off. So anyway, I am Dawn Fotopulos. I thank the Biz to Credit people who are a fantastic strategic partner. This is the end of the trilogy of the Hidden Profit Academy. I am Dawn Fotopulos. I am here for you. Please reach out to me on LinkedIn. Reach out to me with my private email, dfotopulos@gmail.com, if you have any questions whatsoever. I will be sending you a follow-up email with the link to Knowledge Link TV, the Hidden Profit Academy, with courses and pricing. But because you've been on this call, you have access to everything for no cost for the next week. So it's been a pleasure being with you. If you have any questions, reach out to me directly, and I will be happy to answer them. Thanks for joining me. Take care. Bye for now.